All right. So stock splits are a really interesting phenomenon when it comes to the stock market. Basically, what happens is that over time, share prices go up, right? And that as the share prices go up, especially if a company's done really well, their share price can get so high that it actually becomes very inaccessible for investors, that it makes it really hard to buy a share. So typically when stocks are doing really well, they consider this idea of a stock split. Now, I want to be clear that when it comes to a stock split, this doesn't affect the company's financials at all. Really, this is just a mechanism to make it cheaper and more accessible. Really, what we're trying to do here is to keep the company's market value at the same level. And if the market is going to be, the market cap is at the same level, but there are more shares in the market, then really what you're doing is lowering the price of the share, your price per share, while keeping the company's value at the same level. So this gets a little bit tricky. You can see the definition here on Investopedia. A stock split is when a company divides the existing shares of its stock into multiple new shares to boost the stock's liquidity. So hopefully this means that people are going to be buying and selling more often. Although the number of shares outstanding increases by a specific multiple, the total dollar value of the shares remains the same compared to pre-split amount. So this is my way of saying that financially nothing really is happening here, okay? That the company's going to be worth the same, the shares are going to be worth the same, the dollar value of the shares is going to go down, but you're going to get a number of shares such that, it'll still be worth the same. The most common split ratios are 2-to-1, 3-for-1, which means that the stockholder will have 2 or 3 shares respectively for every share held earlier. So if you had 1 share in a 2-for-1, you would now own 2 shares and the price would go down by half. Whereas if you're 3-for-1, for every share you owned, you're now going to own 3 shares, but the price is going to be cut by 2/3, so a third. Now, the major companies that are about to do it, so Tesla is doing this. You can see this is an announcement from 9 days ago here, where they're doing a 5-for-1 split of Tesla's common stock. So what this means, so Tesla has been on a tear lately. And Grant, I did see your question pop up there about the markets. I can speak to that in a bit. And Vince, I will get to your question about emerging markets just a little bit, but let me get through this stock split explanation. So, okay, here's Tesla's share price over the last 2 years. This has just been incredible to see it go from about $250 a share. I remember when it hit 900, right? This would have been in February. That it hit 900 mid-Feb, and it was just like, wow. I was so impressed, thought, Tesla, okay, this is probably, a little bit too high of a company valuation. From there, it did drop down in the crash, just like everything did, by, almost 50%, probably a little bit more, 45%, but then it has just bounced back up, and not only to where it was in February, but it has since, I think, doubled in price. Yeah, look, it's about to crack $2,000 per share today, right? And this is up 6% in the last week. I'd have to make this like every day so that we can see, just the meteoric rise over the last little while. It has just been on a tear. So right now, if you wanted to buy 1 share of Tesla, it would cost you $2,000 US. Now, obviously, this is a problem. Let's say you're a retail investor, you have a $10,000 portfolio. You're just getting started, right? You have $10K to invest. If you buy 1 share, that's going to be 20% of your entire portfolio. So what Tesla is doing is they are doing a 5-for-1 split, meaning that for every share of Tesla, right, you're now going to get 5 shares, which means that this share price, I'm just going to call it, let's call it 1990 divided by 5, right, means that shares are now going to be selling for $398 per share. Now, obviously, I don't know what the share price is going to be in a week when they actually do this, so, but really what they're going to do is just do this little math division such that the company is still going to be worth the same. Tesla, the market cap is worth $370 billion. So if I wanted to buy every share of Tesla on the global stock market, it would cost me $370 billion. And then from there, this is going to stay the same. It's just that they're now going to have 5 times as many shares in the world, and that each share is going to be worth a fifth of what it is on that date. So that's how a stock split works in reality, that for every share that you own, you're going to get 5. Really what they're doing is they're trying to make it more accessible, more affordable, especially for retail investors. Now, in the US, they do have these things called fractional shares where you can buy half a share or a quarter of a share. We don't have that in Canada. So this is really going to be helpful for people that do want to have, shares, a share of Tesla or shares in Tesla, but don't want to break the bank and don't want to necessarily put a huge percentage of their money, especially if they're starting from a smaller amount. Another company that's doing this is Apple. So you can see Apple has actually done it a few times before. This is just like their investor relations page. You can see that they have done it. They did 7-to-1 in 2014, 2-for-1 in 2005, and 2000 and 1987. So they've done it a few times. What they've said here is July 30th, they announced a 4-for-1 split. And this is going to happen at the end of the month. So again, Apple right now, largest company in the world, largest publicly traded company in the world, has a market cap of over $2 trillion, which again is a little bit absurd that there's a company that large, but it is what it is. You can see Apple shares trading for, let's call it $470, right? So what they're doing is they are doing this 4-to-1 split. What this means is that for every share of Apple that you own, you're now going to own 4 shares. And what it means is that I expect this share price to go from $470, right, down to $117. So this is going to make it easier for retail investors to be able to buy shares of Apple. Really it's funny when it comes to share price. Personally, I'm a fan of these splits. I think it should be accessible. I like smaller amounts. I always say, I don't care how many shares you own. I care about the value of those shares. So I would prefer to have the smaller amounts just because it makes my math a little bit easier. I don't have to round as much. There are some companies like Amazon that should probably do a share split. One share of Amazon is worth $3,300, which is just ridiculous. If you're just starting off as an investor and it's like the minimum amount is $3,300, it's just absurd. The most ridiculous one is Berkshire Hathaway. I don't know. This is Warren Buffett's company. So they've got a few different shares, but the A shares, which is like the original shares of Berkshire Hathaway, one share costs $308,000, which obviously is just taking this to such an extreme. The way they did it is rather than splitting shares, instead they do have these B shares, which trade at $200 a share, so a lot more affordable. This would be a way for investors to buy into Berkshire Hathaway. So sometimes companies will have this second class of shares rather than doing these splits. So that's what's going on in terms of Tesla and Apple. Really, really interesting case with what's happening to Brookfield Renewable. Brookfield Renewable Partners, many of you would know this is one of my favorite holdings. I do own shares in this company. This is a renewable energy utility that trades on the Toronto Stock Exchange. So big fan of this company, that they do own all of these renewable energy projects. So they actually went forward with the split. This was announced on July 16th. So this happened a little while ago, a couple weeks ago. It happened on July 27th. So what they did is they actually created a new company. So this thing called Brookfield Renewable Corporation, which has its own ticker symbol. And what happened is the way they did it is that the holders of Brookfield's limited partnership units, this is the BEP.UN that we all owned before this, that for every 4 shares that we owned, we got 1 share of this new corporation. So this is a really weird way of doing a split that they didn't, it's not a traditional split. Instead, what they've done is they've created this new corporation. They've told investors of the old structure that you can basically, for every 4 shares that you own, you're going to get this like free share. What that effectively did is lower the share price for Brookfield. I remember there was one day, the day they did it, where the share price looked like it fell, but it's because it fell just as much as all of these new shares were worth, or at least a quarter of what they were worth, because you needed 4 units in order to get one of the new company. So, really it's been interesting. What this means is that if you owned Brookfield before July 27th, you now have this new share inside your direct investing account for Brookfield Renewable Corporation. It's been really interesting following why they did this. So basically, Brookfield, they do have different divisions, and they've been doing this across all of their different divisions. So this is Brookfield Infrastructure, BIP, right? And again, this was last year, September of 2019, where they did the same thing, where they created this new corporation. They announced the split. In this case, it was, you would get 0.9, so 1 BIPC Class A share for every 9 units held is kind of how they did it. So it was really interesting kind of tracking that, and we can start to see some performance. So let me explain it first, and then actually then I'll chart it for you. So, Cucumber Pilot. Yeah, great that you're able to catch one of your streams. I'm so happy you're joining. It's a cool feature. I love doing these live shows. Thanks so much for tuning in. So when it comes to Brookfield, this is the new corporation. So you can see here they have this little explainer. We are giving investors the flexibility to invest in Brookfield Renewable either through the current partnership, LP limited partnership, or through a newly created Canadian corporation. So really the way that it works, as I told you, for every 4 shares of the old units, of the old shares that you owned, you got 1 share of the new corporation. From there, they are supposed to be economically equivalent, meaning that it really doesn't matter from a financial perspective whether you own the old limited partnership shares or whether you own the new Canadian corporation shares. That in terms of profitability, it should be the same, that they should be identical. And I have heard that these are fully exchangeable, that you should be able to go back and forth between them, which to me is interesting. And so if you are thinking of switching, because there are some slight differences from a tax perspective. So if you do want to go through, I don't know the mechanism for how we do that, but it does appear that you don't have to like sell and then rebuy, that you can actually exchange your shares. So know that these are designed to be, effectively economically equivalent. From there, the reason why they set up this corporation is that, they say expanded investor base, that they will be able to access more investors, but really I think it's about ETFs and some of the rules that some of the indexes have over ETF inclusion. So my hope is that this is now going to be included in more of these ETFs, which makes me really happy, and that there will be some tax advantages for some, which I'll speak to. So, you can see here, that really in terms of broader index inclusion, that they are on the S&P TSX, the Toronto Stock Exchange. So they would be in those, but it looks like they weren't eligible for whatever reason before under MSCI, which, a lot of the ESG ETFs use MSCI. Russell is also very popular when it comes to small and mid-sized companies. So the fact that these new corporate shares will be, or I guess should be, eligible for inclusion, this is a big deal with so many investors using ETFs. You want to make sure that the legal structure makes it eligible for those indexes and for those ETFs. Now, when it comes to investors, really the big deal with this new corporation is that 100% of the dividends are going to be considered eligible dividends and therefore subject to the Canadian dividend tax credit, which is really good news for any Canadian investors who hold this outside of an RSP or a TFSA. If it's inside a tax shelter, it really doesn't matter. What I want to show you here is, where is it? These are all the tax forms. Here we go. So this is now. Hold on. This is European, and I want to see if did they have it for Canadian. I felt like they did have. There was a slide. No, where was it? Here we go. Yeah, it is this. So here we go. Canadian dividend. So you can see here the way it had worked before is that there was a distribution. A Canadian dividend was 50%. From there, the return on capital. So this would be like a different form of distribution. And then there was actually a Bermuda dividend. So you can see here that it kind of was like, there was this weird tax form. If you held it in a taxable account, part of it was eligible, part of it was ineligible. It was a bit of a pain. What you can see here now is with the new corporate shares, 100% of the dividend is going to be eligible for the Canadian dividend tax credit. So I want to see here, hold on. I feel like this might have been from the US site, and maybe I was looking at it from the Canadian site. No, this should be it. But anywho, we're going to have to wait and see until after the first dividend. But, you know, really what I'm expecting here is that this is going to make paying taxes really, really easy. That basically you're just going to get an annual form, your T5 for dividends. Yeah, here it is. This is where I saw it. That now it's going to be an eligible dividend for Canadian investors. So really, if you hold this inside of a taxable account, you're going to want this BEPC unit. That, you know, you might actually consider shifting over your units from the old limited partnership and just holding this corporate structure. That said, if it's inside an RSP or a TFSA, it really shouldn't matter at all.